Make no mistake, regardless of what strategy you pick, that option is decaying at the rate of its theta.
Time is money. Nowhere is that more true than in options trading, because every minute that passes in a trade can work for you or it can work against you. Today we will delve into the power of Theta, the silent force that can make or break your options trades. And to help us understand, we have Matt Cashman from the Options Industry Council in Chicago. Welcome, Matt.
Thank you for having me, John. It's a pleasure to be here.
Let's get straight to the first question. How successful can an options trader be without understanding what Theta is?
Well, theta is one of those things that is really foundational to how options work. As you said in your opening, time is money. And options are interesting because they have an expiration date associated with them. And because they have an expiration date associated with them, they have what we call a decay curve. The decay curve is represented by the Greek theta. If you are making trades that are theoretically hedged or have some volatility component to them, they are going to have some amount of theta associated with them. If you're trading purely directionally, if you are someone who says, I want to buy this call for 2 and I want to sell it for 5, then theta doesn't necessarily play as big a part in your strategy. But make no mistake, regardless of what strategy you pick, that option is decaying at the rate of its theta, whether you're hedging it one way, hedging it another way. The actual theta component of it is foundational to the way that the options work. And it's important that you understand it, whether you're trading hedged up and trading volatility or trading directionally and you're not using the actual volatility that's involved in the options explicitly. Theta's in there and it's happening regardless of whether you think it is or not.
The purpose of this interview is to help you use Theta to your own advantage and to avoid the common pitfalls. We will really delve into that. But first, you have a very long and impressive experience from the options industry. Please give us a short background about yourself as an options trader.
I've been in the options business since 1999. I started on the floor of the CBOE, the Chicago Board of Options Exchange, trading single stock options during the NASDAQ bubble and the corresponding move afterwards. From there, I moved to London and I traded for a large Chicago market making firm in London, but I traded German bond options there. Then I moved back stateside and started an options market making business on the floor of the Chicago Board of Options Exchange and ran that with 4 other partners for the better part of about a decade. And we traded index options, VIX options, all of the index options that surround the S&P 500, the NASDAQ, the Russell, all of those things, and ran it as one giant options book. We wound that down in 2015, and I did some other things, ran some relative value trades for a fair amount of time. Recently, I have landed at the OIC, the Options Industry Council, where I leverage all of that options trading experience to help people understand how options work. So technically, my title is the Principal of Investor Education at OCC, which is where I contribute to the educational aspects of the Options Industry Council. And essentially, I do things like this. I show up on podcasts and webinars and do a lot of talking about how options work. My job is to teach people the basics of optionality, with the thought being that the more people understand about how the options work, the better they're equipped to make decisions in their options trades that align with their actual risk tolerances. So that's basically my experience in a nutshell and where I am today.
Wow, we could not have gotten a better teacher, I think. So, Theta is one of the so-called options Greeks. What do we mean when we talk about options Greeks?
Option Greeks are essentially, and a lot of times I talk about this when I teach option Greeks. I talk about option Greeks as like a dashboard for your options position. In much the same way. And the reason why I use that metaphor oftentimes is because everyone understands how driving a car works as far as the dashboard is concerned. For instance, you don't need to stick your head out the window when you're driving to figure out how fast you're going. The speedometer tells you how fast you're going. The tachometer tells you whether or not the engine is running. The Greeks are very similar to that, but in option terms. When we talk about the Greeks, the main 5 Greeks that people most of the time have on their headline risk numbers are delta, gamma, theta, vega, and rho. These Greeks are basically just ways for you to quantify and manage the different risks that are in your portfolio. Theta, that we're going to talk about today, is essentially a measure of how much your option or your option's position in aggregate is going to decay over the course of a 24-hour period of time. And so, as I said before, the reason why options have theta is because they all have expiration dates. If you have an actual asset that is going to expire at a certain date, the optionality of that asset has to decay at a certain rate. Theta is the way that you can see how much that decay is centered over the next 24 hours of that asset.
Maybe we should bring up a definition of theta. We have a slide with it here.
So as you can see here, the technical definition is it's an option value sensitivity to time. It essentially tells you how much it's going to decay over the next 24 hours. And it always appears in decimal form. The theta of an option is going to be expressed. In this case, when you see it here, it says 0.08, and it's expressed as a negative number because theta is intrinsically negative. It comes out of the actual option value, and it's expressed per calendar day. Theta doesn't care if it's a weekend. Theta doesn't care whether the exchange is open or closed, and it represents a cash amount per option. And the other thing that you need to remember is that all options, both calls and puts, have theta, and they are expressed as negative theta amounts. The other thing that's interesting is that if you're looking at an option that's on the same strike, those two options, so for instance, the 50 call and the 50 put, are going to have the same theta amount. The reason why is because of put call parity, because the actual theta comes out of the extrinsic portion of value that's in those options. So for instance, on the 50 call and the 50 put, they both have intrinsic and extrinsic value. One of them is going to have more of one than the other, but the only part where theta is actually working is on the extrinsic portion of that value. So the extrinsic portion of that value is going to be the same for both of those options. And thus, that part is going to be decaying over time, and it's going to have the same theta amount if it's on the same strike in the same month, essentially.
So what does this mean in practical terms for the option seller and the option buyer?
That's a great question. Theta is expressed as a negative number. When you look at it on an options montage, it's going to tell you this thing has 8 cents of theta. What that means is that theoretically, that option is going to decay 8 cents over the next 24 hours. But the way that you can think about it when you're thinking about either buying or selling options is that although the theta number is negative and it's expressed as a negative number within the model, theta depends on whether you're buying or selling that option. The option itself is going to change in value over time. It's going to do whatever it's going to do, whether you're long or short it. But if you're long that option and it's decaying over time, meaning it's losing value, what that means is that if you paid $200 for something and it has 8 cents of theta, it might be worth $192 the next day if nothing happens. And that means that the $200 you spent for it is now $192 in the actual free market. So that thing, that asset, that option has lost 8 cents of value over the 24 hours of time. If you were short that exact same option, if you were the person on the other side of that trade, you had sold that option to someone else and they had given you $200 for it, theoretically, over the next 24 hours, if it was trading the equivalent of 192, you could buy it back for 192. And thus, that's why people look at Theta as kind of a profit center. Many times people look at selling options as a strategy that allows time to be on your side. In that situation, what I just described would be something where time would theoretically be on your side. If you sold something for 200 and you were able to buy it back for 192 24 hours later because nothing happened, that's how people who sell options think about Theta most of the time. Now, like I said,
And hence the name of this website, Theta Profits, because
exactly,
I am myself an
exactly.
option seller. And option sellers, we love Theta because it
Yes,
benefits our trades in general.
indeed, indeed. I should say one thing, and I always say this when I talk about Theta. It's not a guaranteed number. It is something that is a function of many different things. It's a function of how much the option is worth, whether it has this amount of delta in it or that amount of delta, or the implied volatility level is where it is. The last thing that I want people to think about Theta as is this, and I hear the word oftentimes used, income, when people talk about Theta. I'm not a huge fan of talking about it that way because my job is to express the risks and the benefits of every single strategy. There are different ways to make money trading options, both from the long side and from the short side. Some people prefer to trade from one side or the other for various reasons, and sometimes Theta is one of those reasons. But it's important to realize that it's not as if you can just walk into a situation, sell every option, and then make a bunch of money. There are certain situations where that might occur, but I can give you lots of different scenarios in which you would do that exact same thing, walk in, sell a bunch of options, and lose your entire account based on different ways that the stock might move or that the implied vol might move. Right. So it's not a guaranteed function of the optionality. The actual decay itself is happening in the background.
But is the decay the same steady amount every day throughout the lifetime of the option?
No, and that's a really great question and a good segue to another part of how we think about Theta and how I want people to think about Theta. Theta is not linear. It's not perfectly linear. Many people are going to look at it and say, well, the option itself says that it has 8 cents of Theta, so it's going to lose 8 cents every day. And the answer to that question is no. Theta is an actual representation of the next 24 hours. And so if you think about Theta as a part of the options life cycle coming out of it, I want you to think about it in this way. If you had an option that had 100 days in it and you were to pull 1 day of decay out of it, you would have pulled one of 100 days out of it. And so that's not that much of the actual options value, right? It's 1% of the options value. Now I want you to think about an option that has 3 days left in it. An option that has 3 days in it and you're taking 1 day out of it, you're taking 33.33% of its value. It represents a much larger portion of the overall value of the option. And commensurately, that Theta number is going to be a larger part of the entire extrinsic value than it is if you were pulling 1 day out of a 100-day option. And
I
so,
guess that's what we see on this slide here, that
yeah,
it is not always a linear thing.
it's not linear. And generally, people start to think about the part of it that's not linear that becomes exponential in that time frame that you see here, which is right around that 30 to 40-day window as far as days to expiration are concerned. And traditionally, that's when options expire. New options get listed every month. And what we do is we roll it to the front month. We roll the option tenor to the front month. The front month is always thought of, or traditionally thought of, as the 30-day option. And so we always thought, and this was 15 years ago, we called the front month the next options expiration. And that was always around the 30-day mark. When you think about Theta as a part of the options valuation and how much of it is coming out, I want you to also look at the actual curvature that exists in the at the money option here, that top line that has curvature, and then look at the other line that's represented in green below that says in the money option. That option is an option that is in the money or has a large part of its value made up of intrinsic value as opposed to extrinsic value. Remember what I said at the beginning, theta actually affects the extrinsic portion of the value. The intrinsic portion of the value is really just the difference between the strike and where the underlying is trading. And so that part of an option's value does not decay at the same rate or in the same way. It doesn't have the same curvature to its decay function as the extrinsic value portion, which is represented by the at the money or out of the money options. Those options are made up almost exclusively of extrinsic value, and the theta is going to work much more on those options over time, and that's what gives it its curvature like that, as opposed to the actual the more linear decay function of an in the money option.
What about changes in volatility in the market? How will they influence theta?
It influences theta in kind of a secondary way. When you move implied volatility on options, if you keep everything else exactly the same, let's say the stock doesn't move, the days to expiration don't move, it doesn't get a dividend, it doesn't, everything else stays the same, and you raise implied volatility, the option price itself is going to go up. And if you do the exact opposite, if you lower implied vol and keep everything else the same, the option price is going to go down. Now think about this in terms of what I just said, which is that theta works as a function of the extrinsic value portion of an option. Extrinsic value comes from things like time and implied volatility. When you have higher levels of implied volatility, the price of that option is going to be higher, the extrinsic value portion is going to be higher, and thus there's more of it to decay over a certain period of time. Now, if that period of time doesn't change, let's say it's a 30-day option, and what you do is you change the implied vol and the actual vol goes up, the price of the option goes up, what you have is a larger block of extrinsic value that's going to decay over that same period of time. That theta number is going to be higher because there's more value to come out over that period of time. If you do the exact opposite from what I said, and take implied volatility down and the option values go down, that's affecting the extrinsic portion of the value. Thus, there's going to be less of that to come out of the options value over time. And those theta numbers are going to be different. They're going to be lower. So that's why I say it affects it in a secondary way. It affects it because of the effect that implied volatility has on the price. And then the price is what is actually decaying over time.
Matt, I have a question. Many of us retail traders, myself included, really love zero DTE trading, where the options expire the same day. How should we think about theta in a zero DTE setting, and what do we need to be especially aware of?
A very good question, and a question that's especially pertinent to the way that people are trading a lot more now, especially on the retail side of things. As you look at where the volume is, especially in index options, we're looking at somewhere north of 50, 60, 70% of the options being traded in indexes are zero DTE of some sort. So we have this rotation into much shorter dated options over the course of the last, let's call it 5 years. When you're thinking about theta and you're thinking about it in terms of a zero DTE option, I want you to consider the example that I gave previously about a 100-day option pulling 1 day out of it and a 3-day option pulling 1 day out of it. And then I want you to accelerate that curve and think about what does it look like if it's a 1-day option? What you're doing is you're not pulling 1% of the value out of it. You're not pulling 33.3% of the value out of it. You're pulling 100% of the extrinsic value out of that option by the end of the day, theoretically. Now, that has a knock-on effect in many different ways. Number one is the theta that exists is going to be commensurately higher because it's all of the extrinsic value inside that option's value that has to come out by the end of the day. So many times people will look at those zero DT options when they only have theta in their mind and think like, this is a sure thing. There's no possible way. And like I said before, it's important that you always think about theta as a construct of your model and not as some guaranteed amount of money that you're going to be making by the end of the day, because there's other parts of risk that are associated with these zero DTE options. As you get closer to the front of the curve, meaning as you are much closer to the expiration of an option, not only does theta increase, but gamma, one of those other Greeks, increases at the same rate exponentially as you get closer to expiration, especially when you're dealing with at the money or very close to at the money options. Gamma is an option's sensitivity to movement. It's how the delta of the option changes per $1 move in the underlying. And so gamma means, and increased levels of gamma means that that option is going to be exceptionally sensitive to underlying movement. Now, oftentimes gamma and increased amounts of gamma comes with increased amounts of theta, right? And so when you're looking at it from the theta perspective, you may be very focused on the theta of that option, and that's okay. What's important from an educational perspective and also from a risk perspective is that you also understand that an option that has a ton of theta in it might also have a ton of gamma in it. And that means that it's really sensitive to underlying movement, which is part of the reason why I say theta isn't this guaranteed amount of money. If you're dealing with an option that has exceptionally high sensitivity to movement and an exceptionally high amount of theta, the theta that you're going to theoretically harvest from that option is contingent on whether or not the stock moves enough to change the value of that option to the point where the theta portion that you thought you were getting is now the opposite direction and someone else gets that money and you end up paying at the end of the day.
Those of us who are trading zero DTE know that in that last hour before the market closes, anything can happen.
Yes.
Both with gamma and theta and all the Greeks.
Absolutely. One thing that's interesting as far as zero DTE options also, think about that slide that we showed that gave you the actual exponential nature of what the theta looks like. You can essentially take a version of that and condense it down into one day as its life cycle. The actual decay function looks somewhat similar to that from a curvature perspective, where there's a lot of time that passes where that thing might not decay at all. And it just kind of like decays a little bit. And then at the end of the day, everything gets exponential and comes out. If you think about theta as a function of time, you can condense the entire thing down into one 9-hour period, and it's probably going to have some of the same characteristics of that exponential curvature built into that. But that means it's even more aggressive. If you're thinking about it in that way, you're going to be able to watch the curvature happen right in front of you. I think that's the part that is important to remember.
You are speaking to a lot of retail traders throughout the year. What are the most common misunderstandings or pitfalls that you hear when it comes to understanding of theta and how it affects our options trading? And what should we look out for?
The first thing is probably what I have stressed 3 or 4 times already, which is that theta, many times people think about it as this kind of guaranteed income idea, and that it simply is not. If you are trading from the short side, many times people are focused on theta, and as well they should be. It's part of the actual strategy, but it also comes with the other side of risk, which is important that people understand that. I think that is probably the number one misconception about theta, is that people see it as this guaranteed part of the decay curve. And then the second thing that I think is another misconception about it is that people look at it and think that it doesn't change over time. If you look at the actual slides that we've looked at already, you can see that the amount of theta that's in an option for today's modeled day is going to be one amount, and then it will be different tomorrow. It's a function of many of the inputs that go into that option's valuation. The overarching idea that people need to keep in their mind is that theta is not this constant thing. It's dynamic, just like many of the other parts of optionality are dynamic. Delta is dynamic, theta, gamma, all of those things are kind of like moving around, and they're a function of all of the inputs of the model. I want people to think about it as this kind of living, breathing part of what they're looking at in the optionality. It's not something that's like, I looked at it and it said it had 10 cents of theta, and so I assume that it has 10 cents of theta every day until it expires. It's not the case. It's dynamic and it moves and it's a function of the extrinsic value that's in that option. So keep an eye on the extrinsic value of the option and things like implied volatility that are moving the extrinsic value of that option.
Matt, this is a very good walkthrough of Theta, but where is a good place to learn more for a retail trader who wants to delve even further into this topic?
The Options Industry Council, that's basically what we do. We teach people how options work. Our website, where we host all of our educational material, is a fantastic place to do this. It's a I would say an underutilized asset for the community, but it's free of charge and it's on demand. And optionseducation.org is where you'll find all of our educational assets. You're going to find webinars, podcasts, presentations. If you go there and all you really have to do is create a login and a password, and that unlocks access to all of that educational material that and it's also constantly updating. It's not some stagnant, educational material. It's always
It is really an amazing resource, and it is also refreshing from the perspective of a retail trader that you are not trying to sell us a service.
That is true. And also, John, one of the best parts of my job is that I don't ever have to sell a service. It's an altruistic part of what we do. We want people to be well informed about how options work, but we also know from the options industry, right? We are representatives of the options industry widely. And so we know that a user that is more well informed and understands the basics of optionality is probably going to be a longer term user who's going to understand better the risks and the benefits of how these options contracts work.
I have to say, also recommend a few of the videos that we have on these channels, that there are several videos with strategies that are trying to benefit from the decay of Theta. Thank you very much, Matt, for joining and giving us such a great introduction to the concept of Theta.
It was great to be here. Thanks for having me.